All caps.
Cool.
That's why I'm like,
oh, nice.
I choose to leave the meeting.
What's up here? Oh, I'm
Okay, she's
ignoring
got
her.
it.
Okay, cool. So this is called Mortgage Mythbusters. Basically, what we're going to be doing is just talking about all of those things that, like, you hear people say, oh, well, what about this? And, you know, I've been wanting to buy a house, and so I've been Googling stuff, and I've been talking to somebody like my aunt and uncle who bought a house in 2006 or 2005 before the meltdown. And all of that information is like just wrong, right? Like if you've ever gone to the doctor and they give you like a lab report or something like that, and you Google, you know, details on it, then all of a sudden you freak out.
Yes.
And then you end up talking to the doctor about it. And I did the same thing once, and the doctor was like, seriously, stay off of Dr. Google. What are you doing? Like, and he kind of chastised me about it. And the thing is I deal with that in mortgages all the time. And I'm sure you guys deal with it in real estate. I don't know if I can think of an example off the top of my head for you guys, but I'm sure it happens absolutely every single week.
The housing bubble is gonna pop.
Yeah, that's
That too, yes, which I guess that would apply to real estate agent questions as well. I know I sure get it a lot on the mortgage side of things. So there's just going to be a lot of just different things that we're going to touch on as we go through this, but also most importantly, this is not just about me being up here talking to you guys and you guys just nodding and agreeing, because I want to hear from you guys too. Like this class is really, really important to be interactive for me because I love talking with people. I'm not as crazy about being the only person talking all the time, okay? So this is gonna be as interactive as possible. So was that a good nod? Hey, okay.
I don't know, did the slide change?
Oh, the slide did change. Cool, nice. She's picking up, perfect. So first things first. A buyer who puts less than 20% down must pay mortgage insurance. Is this true or false?
True.
I thought true.
false.
A buyer who puts less than 20% down must pay mortgage insurance. Haley, that's your cue to press the next button.
Oh, okay.
It is true. So it is true because if you're putting less than 20% down, then it is a higher risk for the lender. And really all the lenders are interested in, like basically their whole process in lending money is just plain managing risk. And the best way that they manage risk is by taking a look at statistics over just decades and decades of data from homes that have either not gone into default or have gone into default. And they have found that statistically speaking, if you have less than 20% down, you know, if the borrower goes into default, the lender could end up losing more money at that time, right? Because they have to unload the property, it may not sell for exactly what they were thinking, and you know, sometimes that mortgage insurance is required to cover the shortage. So let's talk a little bit about the different types of mortgage insurance. Go back. We're gonna still talk about these 3 bullet points right there. Thanks, Haley. It's okay, you're just so eager and I love it. Lender paid MI. MI stands for mortgage insurance. You're also going to commonly see the acronym PMI, that stands for private mortgage insurance. Both interchangeable, both the same thing, essentially. Mortgage insurance is just, you know, what you have to pay in the event of a default. That insurance helps the lender from losing all of their money, basically, because there's not as much equity in it. Does that make sense? Does everybody understand the purpose of mortgage insurance?
Yes.
Yeah. Okay, cool. So let's talk about the different types. So we have, the first one is going to be lender paid mortgage insurance. And that's where the lender pays for the mortgage insurance by increasing the interest rate itself. And so sometimes you'll hear lenders out there who will say, yeah, we got this amazing deal right now. You can put 10% down and there's no mortgage insurance. Well, there probably still is mortgage insurance. It's just that it's included in the interest rate. Now, there are benefits to that, but you still have to understand that at the end of the day, the cost is still passed along to the borrower for the mortgage insurance. But when you increase the interest rate, then like, let's say the going rate is 4.5 for the interest, and then the mortgage insurance premium on lender paid mortgage insurance is 0.5%. So they would actually increase the interest rate to 5%, and then they get to say there's no mortgage insurance, but technically we know that it's built into that interest rate. Now, there is a benefit in doing that. It's not always the best option, but every single lender is different. And every single, honestly, sometimes the rates will change from month to month. So the main benefit when you do include the mortgage insurance in that interest rate is the fact that you get to write off that full interest on your taxes, as opposed to having mortgage insurance separate, because you can't always write off mortgage insurance. In fact, most of the time you can't. So that's the first option. The second option is borrower paid mortgage insurance. That's when the borrower pays, I should tell you this. I will accidentally call buyers borrowers a lot, because lenders refer to our clients as borrowers because they're the ones that are borrowing the money from the lender. So if I accidentally say borrower instead of buyer, just know that those terms are used interchangeably. And also, if I use any acronyms that I don't explain, just raise your hand and tell me that I didn't explain it, and I will go back and I'll explain it, because I don't want to just say things too fast or use acronyms that go right over your head, because I want you to learn about this too. So borrower paid MI, this is when the buyer pays for the mortgage insurance separately. So you're going to have same scenario, maybe 4.5% interest. And then that 0.5% would go towards the mortgage insurance. The mortgage insurance rate will change on every person. Everything is different when it comes to their specific profile. But that 0.5%, you'll have a separate line item on the mortgage statement that shows mortgage insurance. And that's being paid for the mortgage insurance. There's different ways that you can remove the mortgage insurance without doing a refinance. But that's something that you would end up calling the mortgage servicer about. So there are a few benefits to having it separate, but it is more of a case-by-case basis. So if you have specific questions about that, let me know. But generally speaking, those are the key points to remember, that buyer or borrower paid mortgage insurance is that the mortgage insurance is separate. Lender MI buyout. This is when the buyer pays an upfront fee and the buyer does not pay monthly for mortgage insurance. There's some pros and cons to this as well. Just like I said before, with mortgage insurance, it's going to be different with each buyer and each transaction itself, because in a situation like we're in right now, actually, let me rephrase that. Let's say somebody in January of 2020 put 5% down, and they did a lender MI buyout, that they paid an upfront premium based on the amount of time the lender will project for how long it's going to take them to achieve 20% equity. And so they probably paid a hefty fee if this person did an MI buyout at the beginning of 2020. And then values went crazy, right? And so they may have, ended up spending too much money, because they would have just achieved that 20% equity organically a lot faster rather than paying it all up front. I'm not saying that to say that that's not a good option. I'm saying that so that you understand that every single option is different, and unfortunately we can't tell the future. So it's going to be different every time, but it's important to understand the mechanics of it, because who knows, maybe the client has their own opinion on where they think values are going to go. And if that's what the homeowner's opinion is, then we should, try to fit those needs and appeal to their opinions on it. Sorry, she's been watching so attentively, and then the one time I was ready, she looked away. So not her fault at all. Okay, cool. Yes. DU approvals are the best form of approval documentation. True or false? Very close. Kind of a trick question.
How is it kind of close? It's clearly
It's not true,
Well,
it's just false.
It was.
Didn't
Very
you
close.
just
The re-
tell me last week?
It is true. It is true.
It's his truth.
It is true. But Leslie and I had a conversation about this last week. You're right. It is. I said kind of. It's false. You were absolutely right. But we had a conversation about this last week because there are different types of pre-approvals. And it's so important to know the difference between each and every one of those. Hi, Jay. Do your thing, man. Okay, cool. So let's start with the first one. Pre-qual. A pre-qual is basically, so honestly, each lender is going to have a slightly different definition of what a pre-qual and a pre-approval is. To be honest, this setup here is between the pre-qual and the pre-approval. This is the most commonly accepted in the industry. But the most important thing to remember is the difference basically from the dash on over, because the pre-qual, like initial review, is going to be a credit only review. So they pull the credit, they want to make sure that the credit score is within the range that it should be. And the documentation sometimes is not actually verified. So that means the client says, I make $25 an hour and I don't work any overtime, or my monthly payments are, minimal, and I don't have any alimony or child support. And, we just have to take them by their word. Pre-quals, you're really not going to find in this market at all. Sometimes in other markets, they start coming back, but honestly, not really what we deal with these days. Pre-approval, credit pulled and actual documentation verified. That means if the person is hourly or salaried or commission only, we actually take the pay stubs and determine what their actual income calculations are. There's going to be a different calculation for each type of income. You're going to have like salaries are real easy because it's like, this is exactly what I'm making. But if you're hourly, we have to determine, are you actually full-time? Are you working 40 hours a week? Or are you working maybe 30 hours or 35 hours a week consistently? Sometimes people have overtime or commission or bonuses. Now, overtime, commission, and bonuses are going to be averaged over 2 years of receiving that income. And so if someone has been consistently doing 40 hours a week and they make, X amount of money per month based on their full-time hours, and then all of a sudden they started working like 20 hours of overtime for the past 4 or 5 months, and they feel like, oh my gosh, I'm making so much more money. You are, but the lender wants to know that you can actually keep up with those extra hours, because it's hard to work extra overtime hours. And so they just want to see that you're actually cut out for it. Lots of other things that we could dive into on the documentation verified, but the most important thing to remember is the fact that they actually get everything verified. The best form of approval documentation is a lender pre-approval, or now when I said lender pre-approval, I'm sorry, I should have written underwriting pre-approval or TBD approval. And that's when the underwriter actually reviews the credit, income, and asset documentation. Now, I am not an underwriter. I'm a loan officer. So I interface with the client directly. I call the listing agent when you make offers, or update the listing agent as we go through the process. I talk to the buyer's agent through the process. We, as loan officers, need to be available to our clients and agents. And so the actual hard decision making is given to the underwriter, because the underwriter is the one who all day long, they look through all of these files and they know that their company says, these are the guidelines that the person has to fit within to be able to get the loan. Now, even though I, as the loan officer, know these guidelines, this isn't something that I write out and say, this person, like, yes, they're getting the loan and I can't give that stamp that they're good. I can tell you based on my education and my experience in the business that yes, this loan should be fundable. However, the underwriter is the final person because they work for the company that lends the actual money. So that would be your absolute best form of approval documentation. The reason the DU approval is not necessarily the best form or absolute top best form is because in a DU approval, you're actually relying on the accuracy of the loan officer's data input. So a DU approval, who does not know what a DU approval is? Okay, cool. I just want to make sure somebody needs to have that explained. So a DU is DU stands for desktop underwriter. There is a synonym basically with desktop underwriter, and that's going to be LP, and that's with loan prospect, or that's called loan prospector. Now what DU and LP are, is those are AUSs, which is an automated underwriting system. And so sometimes, you know, a listing agent will say, hey, we need to get the DU, but sometimes they'll be like, I don't have a DU, but I'm sending you an LP because it's the same thing as far as what you need it for. But maybe for some reason, I want my client to have their qualifications because I know their qualifications better fit loan prospector. It's just a different type of loan, but it's still the same type of like automated underwriting system. And so it's an automated system that basically reviews all of the input data, and it reviews the credit report as well to make sure there's no bankruptcies or short sales or things like that. But just remember that it's just an automated system that basically just like checks boxes. And it's like, well, did they put this number here? Did they put this number here? So if the loan officer, you know, said, well, it's the findings on DU aren't coming out the way I want them to, so I'm going to change this number and this number to make it work. It may not, you know, the underwriter, when it actually gets to their desk, they may say, you shouldn't have done that. It needs to actually be this. And so that's why really at the end of the day, the best form is an underwriting pre-approval. Perfect. Shopping around for rates will hurt your credit score. True or false? False. Let's find out. True. False. So here's the reason why it's false. And this is so valuable for when one of your clients says, I'm really frustrated with my loan officer, and let's say it's a bank or a credit union that they're like, I can only get a hold of them. Sorry, just taking pictures, go for it.
Taking a picture of you, Mike.
This is the important stuff. So let's say they're frustrated with whatever it may be, whether it's the loan officer, the bank offering, like the actual like loans that they're offering or anything. You can, you know, tell them, hey, what if you talk to my loan officer? Maybe they can give you a second opinion. Maybe you can get approved for a higher amount, or maybe they can give you a different loan option that maybe has a lower interest rate. And then their response, more than likely, 9 times out of 10, will be, well, I don't want to necessarily hurt my credit score by having it pulled again. And it won't, as long as within 30 days of the first mortgage-related credit pull, if that credit is pulled again within 30 days, it only counts as one inquiry. Hi, Matt. And as that one inquiry hits their credit, it's actually, you know, it's actually allowing them to shop around different lenders within 30 days and get an actual apples to apples competitive rate. Prior to 2008, that law did not exist. And so you would go, like, let's say you wanted to price out 5 different lenders. Well, the 5th lender always had the worst rate, and the first lender always had the best rate. But then by the time you go back to the first lender, it's a vicious cycle. So that's why they made this rule. I know that was a fast one. Sorry, Haley. All right, a low credit score will increase the buyer's interest rate.
Yes.
True or false?
True.
True.
Let's find out, Haley. True, all right. Basically, everybody got that. So here's the thing to remember though. There is a little bit of, potentially this could not actually apply, but 9 times out of 10, it is true. So the interest rate effect, if someone's credit score is lower, has to do with the bucket that the buyer is sorted into. Now, what a bucket is like, let's say someone has a 701 FICO. Well, a lot of lenders will price a specific interest rate from 680 to 700. And then they'll price out another bucket of interest rates from like 700 to 720. So that person with the 701, if they drop 2 points to 699, then their credit score gets worse. But if that same person instead had a 720 credit score and they dropped 19 points down to 701, they still get the same rate. Did that make sense? So it really comes down to the bucket that you're sorted into. So really, at the end of the day, when people are a little concerned about like, oh my gosh, what if you pull my credit and maybe it's been more than 30 days since they got pre-approved the last time. And I go, okay, what was your credit score? And they said 740 or 739. And I go, oh, okay, well, you'll be priced into this bucket. And even if your credit score drops 5 points from a new hard inquiry, you'll still be sorted within the same bucket and it won't necessarily hurt you. At the end of the day, really, no matter what, the client's getting the interest rate that's associated with their credit score, but they're going to be asking these kind of questions. And it's important for us to make sure that they feel good about the process. Adding a cosigner to a mortgage with a better credit score will improve your interest rate. True or false?
I have no idea. Oh,
It's false. It is. It's so confusing, right? It's a mortgage. You know what? I bet you could even call this a mortgage bank.
All right.
Nobody likes that. Okay. My jokes just don't. I know.
I'm here all.
I know. Thank you. Thank you.
So it's just the difference in whether or not they will be accepted, period.
No. So basically, the key piece in this specific question is that the credit score that is used to determine their interest rate is the lower of the two. So let's say, the question up here was adding a cosigner with a better credit score will improve your interest rate. The reason why that's false is there's so many people who are always like, oh, I have like a 650 credit score, but I'm going to add cousin Joe who has a 750 credit score. And so we're going to get a better deal. Well, the problem is they actually go off of the lowest middle score. And so if you're adding somebody with a better score, you're still the same person with the lowest score. And so your interest rate pricing is still going off of your 650. What's up?
That's why your spouse has to have like the new credit score, right? I've heard a lot of people talk about that. That's right.
Exactly. That's exactly why your
I mean, if your credit
spouse
score
needs
is low, I mean, that's not on.
Yes.
So the only advantage to having a cosigner then is for your payment then maybe because you now have more income in the event that will we cover the cost or?
That's correct. Yeah, so adding another person on there with more income will help you qualify for a higher monthly payment,
On that
meaning
same
a higher
crappy-
sale price.
On that same crappy interest rate.
I'm sorry, say that again?
On that same crappy interest rate.
Yeah, on
Your
the same
score-
crappy
Because
interest
your
rate.
score is still low.
Exactly.
Okay,
Yeah.
perfect.
So that it's a common thing. It's a common misconception. I believe that prior to 2008, it might have actually made a difference. And I don't know if that applied to necessarily mortgages or maybe like vehicles or personal loans or things like that. But honestly, that was, lending stuff from a past era. And so that's why you get, a lot of people that, haven't had to obtain financing in 10 or 15 years, all of a sudden they start sharing info that they heard from 20 years ago. Did you have a question?
I just like.
Okay, cool. Well, if it comes back, like, I'm around, so, all right. Buyers get to choose their own interest rate. True or false? Leslie gets there.
True.
It is true.
We didn't get to change the slide yet.
It's because Leslie knows this inside.
I was so excited. That one I knew for sure from last week.
Yes.
She's cheating.
So here's the thing with your interest rates. Like, does that, can I see like a show of hands? Is that surprising to anyone? Nice. Okay, good. That, like, this is one of my favorite, and George looks confused. I was asking if you were surprised,
He's
not
still,
confused.
he's still Googling it, that's why.
I was checking my credit score and it went down 15 points and I'm like. I was at 740 and I was so excited about it that I checked again. I was like, that was 720.
Well,
I'm like,
remember,
It's
if
all right,
somebody
you're
with a
fine.
higher credit score helps you out with buying something, it
It
still
won't change
goes
my
off
rate.
of the lower.
"Ugh."
All right, so in choosing your own
True.
interest rate, here's the thing. You actually get to choose your own interest rate because each interest rate has a price associated with it.
Oh, gotcha.
So sometimes when you're talking to a lender and you're like, hey, what's interest rates today? Are interest rates going up or interest rates going back or down? Sometimes going bad too. Sometimes our response will be, oh yeah, pricing is, all out of whack today. We refer to it as pricing a lot because interest rates, you can get like a set range of interest rates with a lender. And each one of those rates, interest rates on the loan, has an associated price with it. And the price may be positive and the price may be negative. And so let's talk about paying points, which is the first option. And paying points is if it has a positive price to it. So let's say the lowest interest rate possible is 4%. And that 4% rate costs $10,000. And just FYI, I'm going to use a lot of round numbers here. It is, when you actually go through the process, it's extremely non-linear. And it's really going to be unique not only to each borrower, each buyer and each escrow, but each day and time of the day. Like we've had 2 reprices already for today. Two for the better on interest rates and 1 for the worse. And so 3 times in the middle of the day, interest rate pricing is changing. And so that's why it's so important in these volatile times to make sure that your client is either locked on their interest rate or very aware of the risks if they're choosing to float the interest rate. And if you hear that term float the interest rate, that just means that you're not locked in or committed to taking a specific interest rate. So back to what I was saying about, let's say if you have a 4% interest rate and it costs you $10,000, then you're paying points. That is the term that's used for it. You'll also hear someone call it buying down the rate. Now, that's going to be like a positive price for it. Now, when you're paying points, when you hear the term paying points, does anybody know what a point is or the definition of a point is?
Yeah, 1%.
1% of the loan amount.
Yes.
Nice. I'm so proud of you guys for knowing that.
We just
I
had the
was
test like
waiting
2
for
months
you.
ago.
Because I remember. That's true.
We knew it.
Come to think of it, when we were talking last week and you were like, are you gonna cover all of this in your class? I was like, I don't think so, but I think we talked a lot about this, so that's good. So paying points, we've touched on that. Lower side of the interest rate, higher cost, right? Lender credit means that the buyer accepts a higher interest rate in exchange for a lender credit towards their closing costs. So same scenario, 4% interest costs you $10,000. That's a positive price. Now you go up in the interest rate, and maybe the interest rate is now 5%, but instead of paying $10,000, the lender says your closing costs are $10,000. And because you're accepting a higher monthly payment, because you're accepting a higher interest on your loan, we're actually going to give you $10,000 to go towards your closing costs. And so you can actually, essentially, if you think about it like conceptually, it's essentially like financing the cost of closing costs into the loan, right? Because you're not actually including it in the loan amount, but you're increasing your interest rate, which increases your monthly payment in exchange for the lender covering your closing costs. Go ahead, what's up?
I have a quick question. Wouldn't it be beneficial if you don't have the money upfront to pay for closing costs to have your lender cover it, even if it is at a higher interest rate? Because you can just refinance down the line.
Absolutely.
Right.
That's exactly a strategy that so many people do.
Do lenders not like doing that? Because I know that.
Yeah. Lenders love doing that.
Really?
Do you know why? Yeah, think about this. Just think about this for a second. So I actually have a client that several clients that have gone through this exact thing on, especially in high interest rate markets, which is what we're dealing with right now. When you have a high interest rate market, the monthly payments are higher, which means debt to income ratios are tighter, which means its mortgage affordability index goes down and it's more difficult to qualify, right? Well, if you go with an FHA loan, the interest rates on FHA loans, since it's a government loan, are typically a little bit lower compared to conventional rates. Now, if you're starting lower, then if you increase it to an average rate, then you may actually get some of that lender credit to cover your closing costs. And then maybe you wait 1 year or 2 years and you've built up enough equity in the property to where you can refinance out of a FHA loan into a conventional loan, because now you have more than 5% equity or maybe more than 10% equity. And if you have a high credit score or even an average credit score, and you refinance into a conventional loan and you have equity in there, your monthly payment's going to go down and your mortgage insurance premium is going to go down, if not completely away. Because one good piece to remember is on FHA loans, the mortgage insurance premium, the monthly mortgage insurance premium is the same, regardless of your credit score. But in a conventional loan, it fluctuates just like rates do with your credit score. So if you have a decent credit score, you might be paying less mortgage insurance on a conventional loan. Yes, sir.
No question. So is there a percentage cap of how much you can put down and still be in an FHA? Like it's conventional, you come in at 20, well, let's say you're at 19, and you want to go FHA.
Yeah, no, you can put more than, I believe it or not, I did a 40% down FHA loan one time.
What would be the advantage in doing that?
He got his dream home. I pre-approved him. So the advantage was that he got his dream home, but he got his pre-approval. And then you remember when Costco used to have American Express credit cards and they only took their own American Express credit card? Well, that was his first credit card that he had for like 20 years. He had gotten a divorce like 2 or 3 years before that. And that was the only one he kept from 20 years ago. And so when Costco said we're no longer, have a contract with American Express, he was like, oh, forget that. I'm just going to cancel it because that's the only thing I use it for. And now his only single 20-year credit history credit card is now closed. And all of his new credit cards were only 2 to 3 years old. And so his credit score dropped by like 130 points right while he was in the middle of negotiating. for a property. It literally his dream home. I mean, it's a beautiful home. And he was like, I'm not giving this up. Like, I will pull money from my 401k. I'll do whatever I need to do. He put 40% down and he ended up going with an FHA loan because his credit score was like 590 or something crazy like that. But it can be done. It's always a very unique situation why someone would go down that road, but typically it's credit related. But like I said, totally unique to every person.
So that being said, he wouldn't have had to put the PMI.
Oh, no, he would have to pay. Oh, I'm sorry. I thought your question was.
Well, no,
is
that was
there
the
a
question,
cap?
but now that's my follow-up. So if you're
Yeah,
going in more than 20% in this scenario,
then you still pay mortgage insurance.
just, oh, wow.
Yeah. And you also, so keep in mind also mortgage insurance on FHA loans, there's two different types. There's your upfront mortgage insurance premium equal to 1.75% of the loan amount. And that's just tacked on to the back end of the loan amount. So when someone's putting 3.5% down, their equity after closing is not 3.5%. It's less than that because they add 1.75% of the total loan amount to the back end.
What they're now paying.
And that now they're paying, interest on that
Okay.
1.75% that's added on it as well. There's so many like hidden little stuff on FHA. And that's why FHAs are typically more expensive, but they get the job done. It is a government loan that the government, has built for, helping people to get into homes.
Yeah.
And once you're in the home, start building equity as soon as you can, try to refi into a conventional one. Yes.
So might be off topic, but can you talk a little bit about FHA loans also require different type of inspection rules?
Yeah, so the term is FHA minimum property standards. And so on FHA loans, you're going to have more strict minimum property standards for several reasons. Since it's got less equity in the property, it's a higher risk. Remember at the beginning, I was saying, really what lenders are into is, the risk that's associated with lending, right? With lending on a specific home. So if there's not a lot of equity in the home, then they really, really want to make sure that if you default on the property, that they don't end up having to take back a home that has, horribly chipped lead-based paint on it, and overgrown bushes have been called out on an FHA appraisal, which kind of blew my mind, but they were overgrown and dried and dead bushes. And they were like, that's a fire hazard. And I was like, I guess that makes sense. I was very irritated at the time because I had to, get a reinspection on it, but it makes sense. So.
Does that require a separate inspector from yours, or do you need to notify your inspector that it's an FHA loan?
So it's different than a home inspector. It'll be an actual FHA appraiser. And so it's just like a regular appraiser that has an FHA bond or whatever they call that. Yeah, like certification. That's the word.
Okay.
Yeah. And then
It's still ordered by the lender.
yes, it also still is ordered by the lender. Just to sum this up, the par rate, we talked about the lowest rate, the highest rate. Par rate just means you're not paying any points and you're not getting any lender credit. So like 9 times out of 10, when someone says, hey, what are interest rates today? Typically people are telling you the par rate because most people are going with the par rate, but everybody's different. So if they need help with closing costs, go for it. If they got money burning a hole in their pocket and they're like, I'm going to live in this house for 10 years and there's no way I'm getting out of this loan, then they may actually pay some points because it's going to, really pencil out for them in the math down the road. That's the cue. She's doing great with it. The interest rate your client is pre-approved with is the same interest rate when they close. That's amazing. Let's find out. So interest rate pricing. Oh, that's right. This is a really good key point. interest rate pricing is determined by the length of time the rate is locked for. So if you're doing a 60-day offer on a property and you don't tell your lender that you're placing an offer that, since the seller, or I mean, the listing agent has already said, hey, just a heads up, my sellers aren't ready to like be out for a while because we got some stuff going on. So we have to do a 60-day escrow. And then if you don't tell the lender that, especially right now in these volatile rate times, the lender may have quoted the interest rate for the buyer that day at a 30-day interest rate lock. And if the lender now has to lock it for 60 days, that interest rate pricing is going to get worse. Now, based on our conversations about interest rate pricing, you guys understand that when I say interest rate pricing gets worse, that doesn't mean that it doesn't necessarily mean that the interest rate is worse. It means that that interest rate today, if we locked it for 30 days, may be a par rate. Won't cost them anything. That they're also not getting a lender credit. It's flat par rate. But if now all of a sudden you need to lock that rate for 60 days instead of 30 days, it may cost you a couple $1,000s. And so it's important to be aware of interest rate lock periods. Now, over the past 2 years, 2020 and 2021, when interest rates were just like nice and low, and you didn't really have to worry too much about, them jumping up overnight like we do. I wake up with nightmares every night about. Back then, it was like we would qualify someone and actually start the process because we knew interest rates were either going to stay the same or go down. And then once we would get within 15 days of being able to sign loan documents, instead of locking for 30 days, we would lock for 15 days because the pricing was so much better than the pricing for 30 days because we were so close to the end. And again, it all comes back to the lenders just trying to apply their level of risk based around the actual process. So if they only have to lock the rate for 15 days, they're like, we know what that's going to be. By 15 days from now, we know what it's going to be like. Now, in this environment, it's much different. Rates are climbing every single day. And so if you want to go 60 days out, where do you think the rates are going to go 60 days from now? Probably up, because they've been going up.
There's going to be another Fed announcement, and they're going to shoot right up.
Yes. Hopefully it's slowing down. We'll see. Today, the bond market had some shift in it, and we can talk about that a little bit later after we get through this, but it's exciting. H2O, I think that's Naomi. Next. People who make a lot of money in their job / career will always be able to buy a home. True or false?
False.
False. Okay, I'm glad that you guys know that, but we're gonna kind of determine a little bit more about details on why, or some examples on why that might be true. So if the buyer has recently become self-employed, remember when I talked about earlier how, there's different calculations for income, whether it's hourly, salary, or commission, things like that. Well, if you're self-employed, that is like a hard stop as far as like, what do you need to show over the past 2 years to actually look at your average income over 2 years? Because that's really going to give you a good pulse on your business. Now, you guys know that being self-employed, you're all self-employed, right? Because you're all 1099. And so your income as a real estate agent who is new into the industry as a real estate agent, your income will be averaged over 2 years. There's an asterisk that you may not have seen when I said that you've been in the business for less than 5 years. The reason why I said that is because if a client has been self-employed for more than 5 years, and you're talking to them about buying a house right now in this environment, like COVID was 2020 and 2021, right? A lot of self-employed individuals had just a horrible 2020, but they had a decently strong, business that they've owned for more than 5 years. Remember, more than 5 years in self-employed. And at the end of 2021, they were like, I actually had a pretty good year. And now here we are, tax season 2022. And these individuals who had a horrible 2020, but a solid 2021, and have been in the business for more than 5 years, can do a Freddie Mac loan. That's the loan prospector AUS that I talked about before. And that Freddie Mac loan will allow them to calculate their income average over 12 months instead of 24 months. And that's huge, especially for real estate agents who have been in the business for more than 5 years. Yes.
So you could make, I don't know, you could make $50,000 your first year, 75,000 your second year, 85,000 your third year, fourth year you do almost nothing, 30,000 or something like that. And then your fifth year you happen to get 280,000.
Yeah.
You could qualify for a loan just based off of
Based
that
on
fifth
that
year.
fifth year.
Okay, I'm just making
As
sure.
long, yeah. So here's here's my one asterisk on that. As long as LP or loan prospector says that you can use the 1 year. Now, that will be in your AUS findings. It will say whether or not you can use 1 year tax return. Now, 9 times out of 10, it says yes, you can. I don't think I've ever encountered a time where it said I couldn't, but I know that it is technically the guideline is LP or loan prospector has to actually say that you can. But that is a perfect example of yes, absolutely. That person would be able to use that 250 or 280,000 that they made in their fifth year.
Okay.
And yeah, all you need to do, so documentation required though, keep in mind, the underwriter will likely ask for some sort of documentation from the tax preparer for that self-employed business, verifying that they've been self-employed for at least the past 5 years. Okay. So if you're filing your own taxes, who are you going to talk to? You may not be able to talk to a CPA and have someone write you a letter that says that I can verify that I've been doing their self-employment tax returns for the past 5 years. So if you guys are self-employed, which I know you all are, and you're doing your own taxes, keep in mind that may put you in a situation where, nobody can really verify that. But that's a unique situation, and who knows? I don't know if you want to buy a house or not. Yes, ma'am.
We have a question.
Yes. Hello.
I'm Joni.
Hi, John.
I have a question.
Sure.
Because I have been self-employed on and off over 30 years, right?
Okay.
And I've been self-employed and had a paycheck at the same time,
Okay.
right? But I have a situation where I made a ton of money in 2020. Wow. And then last year I had to take off and not work, caretaking family. Is it a problem when you make less money than the year before?
Yes, it will be.
Yeah.
And it's more concerning to a lender when they see that because they see declining it.
Yeah.
Now,
I've already made more money this year.
okay, well then that's great. That's great because there's three different classifications they will have. Does the borrower, and these are all, the calculations are different depending on the answer to this question in the guidelines. It'll say, is the buyer's income declining? Is the buyer's income, and when I say declining, I mean 2020, 2021, and year-to-date profit and loss statement, okay? So the question is the income declining? Or is the income inclining? Or is it declining and then inclining? And those are three different calculations that the lender will, or the underwriter will apply to the individual. And so if you're making more now, that's wonderful. The threshold of if you have declining income from 2020 to 2021, if the decline was more than 25%, then, okay, yeah, so if it was, then honestly, I'd have to see how they would look at that because it would be concerning to them.
Sure.
However, if you are already making a lot more this year, they may look at that and go, okay, maybe we'll average the whole thing. So at the end of the day, with self-employment individuals and calculations, it's really just up to the underwriter, but it's good to dig deep with the loan officer and say, here's all my info, and take all this, run it by the underwriter and see what you would actually calculate it as. But yeah, you're very welcome. Okay, same information essentially, or I'm sorry, same concept, because it says have they, recently become self-employed, or did the buyer just start a sales job with commissions? Commissions or bonuses, things like that, that's variable income, right? It's the same thing with self-employment, it's variable income. So it would, same rules would apply. They would average it over 2 years. Client needs to have the same job for 2 years. Is this my last slide? Are we coming in on like exactly an hour? I would just be so proud. Okay, then you'll surprise me. You'll surprise me. Okay, client needs to have the same job for 2 years in order to qualify for a loan. False. Or let's see. Sorry, only Haley has the answer. She has to press the next
I
one.
have the answer.
Yeah. False, because it says so, but I was trying to find my sentence there. So couple key pieces to know about that. So a lot of times you'll hear people, again, those people prior to 2008 that are like, yeah, well, you got to be in the same job for 2 years. Not necessarily true, but you do have to show the most recent 2 years of employment history. Now, what they're going to do is they're going to look at the 2 years of employment history. Maybe someone was working 2 jobs. If they were working 2 jobs for the full 2 years, you get to use both jobs' income. If they've worked 2 jobs, but only 1 job for a few months and here and there, so that's sporadic, they may only use the 1 primary job. Let's say maybe they're in a field where they kind of go contract to contract and they just work as a W-2 borrower, but they only, maybe they switched or maybe they moved and they've had 3 different jobs over the course of 2 years. As long as those 3 different jobs were still within the same field, then that homeowner or that buyer is using their same skill set in all the different jobs. And so the underwriter will look at that and say, they know what they're doing, this will be fine. But if someone goes from being a daycare preschool teacher and then next month they work for an engineering firm or an architect firm, the underwriter may have a few questions about that. I'm not necessarily saying that they won't count it at all, because they very well might if the person can actually prove through documentation that what they're doing is actually a betterment for themselves and that they are up to the task. But keep in mind that underwriter is going to be pretty strict with the documentation. They're going to ask lots and lots of questions because they want to know that the shift in skill set.
Could somebody who maybe just finished med school and is now a doctor, but also not in that 2-year time frame, qualify because it was a shift from school into the same industry?
Yeah, so the general rule is 2 years of professional school like that. And so that's going to apply to nurses, doctors, medical field, engineers, attorneys, things like that. So the general rule is 2 years of professional education will equal 1 year of employment history. And so if they have a 4-year degree, they may not let them do that right out of school, but they're certainly going to be like, okay, it's not like this is a foreign concept. And it's not like you just started learning about engineering yesterday. You've been going to school for 4 years now. So you probably have some basic knowledge about it. And you obviously got hired by a prestigious firm. So you're probably good to go. And also, it also comes down to how they're getting paid. Are they a salaried individual, like an engineer? A lot of engineers are salaried, but like I have a borrower who's working for Kaiser, and if they go to work for Kaiser and Kaiser's like, hey, we're not going to say that you're guaranteed 40 hours a week. We're going to guarantee you at least 30 hours a week because that's what they need to for their HR or whatever. But the actual hours worked are actually like 50 hours or 55, 60 hours a week because it's the medical field. But if you ask Kaiser, they will say, yes, they're getting minimum 30 hours a week. And it's like, well, come on, guys. It's kind of a pain in the neck, but we've dealt with it before. We'll keep dealing with difficult employers and still sell homes. Employment gaps under 4 months may still be eligible for financing. Sometimes people lose their job. It's okay. It just happens. But if that gap is less than 4 months, the underwriter may say, well, there was a pandemic. A lot of people lost their job. So that's something that we dealt with a lot over the past 2 years. But it's something that, just keep in mind when the key piece to remember with this is not to remember this specific guideline, but remember that if someone has a small gap, that they just need to talk to their loan officer and have the loan officer get some more details and run it by an underwriter because each individual's situation is going to be different. I think that's the last one. It is the last one. And I went 4 minutes over. I'm sorry, you guys. Do you guys have any other questions? Otherwise, I can let you get back to your day, but I'm also always going to be around for questions.
4 minutes over, just typically used to like half hour at least of Fritz. So you're doing good.
Do you think Fritz heard that? No,
yeah.
he's working.